Hi, I'm attorney J.J. Childers, Director of Advanced Planning for Chandler Advisors and Special Advisor to the Wealthy Physician. In this video, I'm going to talk with you about something that is near and dear to your hearts, taxes. More specifically and more importantly, I'm going to talk about reducing taxes. Yes, there are indeed ways to actually reduce taxes. Now, this may come as a surprise to you since you've probably been told that there's not a whole lot that you can do when it comes to taxes other than pay them. From the founding of our country, and certainly before that, people have been lamenting taxes. In fact, it was Benjamin Franklin who was quoted as saying that the two certainties in life are death and taxes. While taxes may indeed be a part of life, one of the things that we want to make sure that you know is that they don't have to be such a big part. You see, there are a number of things that you can do to significantly reduce, if not eliminate, certain taxes. The key, however, is that you've got to learn how to do it. That's where we come in. As part of the wealth planning process, you will want and need to consider a wide variety of tax, legal, financial, and investing strategies. Now, while the goal of most of these strategies is to increase your income and build long-term wealth, the downside to successfully accomplishing this goal is that you get the privilege of paying a big fat tax bill. Now, what you may not know is that it doesn't have to be this way. Did you know that different types of income are taxed in different ways? Well, if you're like most people, you may have heard a little bit about this, but you never really understood it. You've got to understand that there's a big difference between active and passive income. This is sometimes referred to as earned versus unearned income. Now, active or earned income is what you receive for things such as your salary or other compensation for the work that you do. Examples of passive or unearned income are for things such as investment income, dividends, and maybe even rental income from real estate. The major difference between these two types of income is in how they are taxed. Earned income is subject to the imposition of FICA taxes. Now, FICA is made up of Social Security and Medicare taxes, which amount to a combined total of 7.65%. In an employment situation, the employer pays 7.65% and the employee pays 7.65%. Well, if you add these two together, this adds up to a total of 15.3%. Now, for self-employed practitioners, this means that they are both the employer and the employee. As such, they end up paying both sides, or the total 15.3%. Well, as you can imagine, this is a pretty big chunk. One of the benefits of implementing a properly structured wealth plan is that you can utilize tools for helping you to overcome this burden. Different entity options can help you to eliminate the self-employment tax in many instances. On top of that, there are many different investment strategies and structures that are specifically designed with tax deferral or even tax elimination as a primary goal. The key is to identify those strategies and structures and find out how you can take advantage of them. Through the Wealthy Physician resources, we provide comprehensive and continuous content on the strategies and structures that you need to know about. I, along with many other contributors, continually work on providing you with the information that you need to know in order to become or remain a wealthy physician. Taxes can and will destroy your opportunity to build wealth if you don't get them under control. Our objective here is to provide you with exactly what you need to help you do it.